The Federal Reserve just unleashed the next stock market boom with the recent lifting of current restrictions. Now, it should be no surprise that the economy and the stock markets are completely disconnected. Gone are the days of value investing like Warren Buffett, where you looked for a great company with a great product and with great profits, and you just bought it and you held on to it forever. Today, businesses aren't in the business of making profits, and stock prices no longer reflect a company's profits or strength. Instead, the markets are driven by Federal Reserve policy, stimulation, and of course, ultimately, manipulation. So if you really want to know what's going to happen with the markets, then you just got to keep your eye on the Federal Reserve, which brings us to their latest action that we're going to discuss today. So in this video, I'm going to show you the policy change that they just made. I'm going to explain to you how this small policy change has actually been the largest driver of stock market returns for the last 30 years, why it's changed a year ago, why it's been changed back now, and then what we can expect and should be watching for. So let's go. All right, before we dig in, if you're new to the channel, my name is Mark Moss, and I make these videos because I want to change the way you think about money, because almost everything that you've learned is completely wrong. And if you can learn to see it, if you can learn to think about this differently, then you can have more freedom, more options for your life, for your family, and for your future. Now, if you like the sound of that and you want to help me get these to more people, help me out with the algorithm, take a second, click on that like button. If you're not subscribed, hit the subscribe button and the bell notification so you're notified every time I put a new video out. Now today, we are talking about changes that the Federal Reserve has just made. They changed them a year ago, they've changed them back, but it really started a long time before that. So let's go ahead and jump right into it. All right, so we're talking about the Fed, the Federal Reserve, of course, the central bank of the United States, which is, of course, the reserve currency of the entire world, and that's why that matters. And we're talking about a shift that they have recently made, and it's made a massive impact. Now, going back a year ago when the pandemic first broke out, the Federal Reserve actually placed some restrictions on the market, which fundamentally changed the way the market works in a much bigger way than you might have expected. I'm going to break that down for you. And why they did this is they said they wanted to conserve capital. So they're trying to protect things, but of course, sometimes these things have unintended consequences. We're going to talk about that. But they were trying to conserve capital during the pandemic. And the big thing they did is they said that we need to stop buybacks and stop corporate dividends. All right, so these little things had a massive impact. Let's go ahead and jump into that and take a look at that. So the one thing before we dig in, I want to explain something, and it's about having a macro view. So a lot of times I like to look at things like in a macro view, macroeconomics, you've probably heard that word, looking at it from the top down instead of so many people are looking at things from the bottom up, right? What do you think about this stock or whatever? But it's not about the bottom up, it's about the top down. And so people have asked me, how do you learn how to look at macroeconomics, or how do you do that? And really, it's kind of summed up in this thing called the butterfly effect. You might have heard of this before. It's kind of it's a story, an analogy, and it basically talks about how like a wing flap on a butterfly somewhere far away, like one little wing flap, like a ripple, could create this ripple, and it could go and go, and then eventually it could create a tornado. So basically what they're saying is that one little change over here could have a massive, a profound impact over here. And really, it can peek into the future. Macro allows us to peek into the future. And so one way, I have a quote about that. This kind of sums it up a little bit, but it says that the butterfly effect is misunderstood. It's a phenomenon where a small change, as I just said, right, in starting conditions can lead to a vastly different outcome. And so when you understand the butterfly effects, it can give us a new lens and through which we can view business, markets, and more. Of course, we're talking about markets. And so the reason why I look at this macro view is because one little change has this profound impact, just like they're talking about. And so today I'm going to go back in time, you know I will, and I'm going to talk about how one little change drastically shifted the markets and lead to where we are today. So let's go ahead and get into that. It's kind of like you've watched, I'm sure, a bunch of movies, right, where they have a time machine, they go back in time. And they say, don't touch anything, don't touch anything, because if you change one little thing, it could have this massive shift in the future. But if you watch my videos for any amount of time, you know that I love to go back in history and find these little butterfly effects that have changed things. So let's go ahead and jump back in time. We're not going to go too far back in time today. We're going to go back to the year 1990. All right, so not too far back, about 30 years ago. And at that time, this guy right here, President Bill Clinton, was running for president. At the time, he was running for president against George Bush Sr., who was the current president at the time. And Bill Clinton ran on a campaign, something that he called putting people first, which of course sounds great, and who wouldn't want to be put first? And so of course everybody voted for him. But really what he was talking about by putting people first is he was talking about changing. He was proposing a change to put a salary cap of $1 million for executives. So at the time, of course, a corporation, a publicly traded corporation, any corporation could pay whatever amount of compensation they want. And if they want to pay a CEO $100 million, then so be it. But he didn't like that. He wanted to try to fix this income inequality problem. And so he wanted to put a cap of $1 million for salary for a CEO. Now, let me just explain this a little bit. They could still pay as much as they wanted. However, they couldn't write it off from their taxes. So the way that works is that a business obviously has income and they have expenses. Your payroll, your salary are expenses, so you don't pay tax on that. So you have your income minus your expenses is your profit you pay. So what they said is you can pay more than you want, more than $1 million. However, you can't write it off of your taxes. All right. Now, this became law in 1992, and I'm going to show you some charts to show you why this is relevant. But at the time, it sounded great, right? Sure, income inequality, let's fix that. Let's put a cap on how much these guys can be paid. But you don't understand the butterfly effect, the ripple effect of what happens. Now, there's two ripples we'll look at. The first ripple is in the pay. All right, so that's fine. So they get capped at $1 million. In 92, when this went into law, 35% of executives at that time were making about more than $1 million. So 35% were making more than $1 million. Today, it's 95%. So it didn't slow down the compensation that these executives were. But what changed was that instead of getting a pay raise, a salary raise, instead they got stock options. So instead of getting paid on their salary, instead the salary stayed below the $1 million cap, as they were supposed to per the law. But they added the compensation in the form of stock option pay, and it went from 1.1 million to 8.8 million since 1978. So the rate of their pay has continued to go up. We can see this. Their rate has gone up. The CEO compensation grew 1,000%, while the average workers only grew by 11%. So a pretty drastic difference. And you can see what's interesting here. So we have the CEO to worker compensation right here in this line, and you can see that they are tracking perfectly together right here. So you can see after Clinton's law went into effect, which is this pink line here, the CEO pay absolutely exploded. It's gone up and down a little bit, somewhere between 200 to 300 times the amount of money that the average worker works. So did it slow down the pay? Absolutely not. As a matter of fact, you can see that it exploded the pay. So it didn't even work as it was intended to. But some of the unintended consequences are the market. So the second ripple we're going to talk about, the butterfly wing, the future change in this, was the ripple in the market. And so what we can see here is that the CEO compensation, the amount of money that CEOs were getting paid, not with their salary, but the options, right? The executives began paying themselves stock options, as I said, right? So they couldn't pay over $1 million, so I'll just get $10 million in stock options, for example. And then because of that, they had incentives based on the stock price of the stock. So now, because they were given stock, all they cared about was bringing the value of the stock up. And so when the markets do well, the C-suite, the executives, the CEOs, COOs, etc., they do very well. And what it's turned into is that it's share price growth at all costs. And so what it did is it had this massive shift in the way that CEOs look at the company, executives look at the company, and their number one objective is share price growth, because the majority of their pay is in shares, in stock. And you can see, again, how well that's worked. Again, here, the pink line is where Clinton's law went into effect. And you can see, again, here we can see this going up. As a matter of fact, this dark line is the S&P 500 index. The light blue line is their compensation. And so you can see that as the S&P 500 went up, their pay went up as well. Of course it did, right? I mean, they were getting paid in stock. So of course, as the stock goes up, it goes up as well. But is it the chicken or the egg? Were they forcing the price of the stock up, which then drove the market up? let's get into that. All right, so the next thing we're going to take a look at is a couple of examples. So let's take a look at Apple. The stock market darling, it's done amazing. As a matter of fact, Apple has doubled its market cap. That's how much all the outstanding stock is worth. It doubled it from $1 trillion to $2 trillion from August of 2018 to August of 2019. So in 1 year, it went from $1 to $2 trillion. And what's important to understand is it did this even with its revenue down. So we can see here, this is the stock price going up, up, up. All right, and we can see the PE ratio, the price to earnings ratio, going up, 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 which is pretty interesting. But if we look at it with another chart, what we can see here is that this is the stock buybacks. And this is the part that we want to get into. So as a CEO, I don't really care about the long-term growth of the company. I'm just trying to get the stock price up as fast as I can because that's how I'm going to get compensated. So what they started doing is they started getting into these stock buybacks where the company has money, whether that's excess money, capital, or they're borrowing the money, and they buy back their shares. When they buy back their shares, supply and demand, when you take shares off of the market, supply and demand drives the price of it up. And as you can see during this period, 2017, pretty flat. And then that period, 2018, look how much the price of the stock, I'm sorry, the buybacks started during that time, which of course is what pushed the price of that stock up so high. So what it looks like when you really look at the data is what's really driving the markets isn't about earnings going up. It's about these record buybacks. And so since Clinton's law was passed in 1992, we've seen a record amount of buybacks. So we didn't used to see so many corporations buying back their shares. It wasn't such an important thing. They weren't so single-mindedly focused on the actual price of the shares. They were more concerned with their balance sheets. They were more concerned with long-term growth, long-term health of the company, long-term being the key word, and as opposed to now, all about short term, all about trying to get that share price up at all costs. And so we can see here in this chart right here, I'll bring it up bigger, we can see that, again, Clinton's law right here, this was S&P 500 buybacks, and you can see they were pretty flat right here. But as soon as this law changed, of course, guess what happens? Well, if I'm going to get paid in stock now, I'm going to try to do everything I can to bring that price of the stock up. And stock buybacks went through the roof. We did have a little dip right here. This was during the 2008 financial crash. Of course, corporations were hurting. They didn't have a lot of money. There wasn't a lot of liquidity for borrowing. So we did see the stock buybacks take a little dip there. But for the most part, you can tell they've gone pretty much straight up. And what's more important is this chart right here. And when I look at this chart right here, this shows me the S&P index. So this is the S&P basically going up. And these blue lines are the stock buybacks. And it's pretty interesting that the stock buybacks and the S&P index both move up almost simultaneously. As a matter of fact, we can see a quote from CNBC right here says that companies buying back their own stocks is the only thing keeping the stock market afloat right now. So you can see how this little shift in the law had massive implications, and now it seems to be the primary driver of the stock market. Okay, and this brings us back a little bit more current. So this goes back to a year ago, and as I started out in the beginning, when the pandemic broke out, in order to try to save this fragile economy, to try to reserve their balance sheets, the Fed put a stop to the game. And the Fed stepped in and said, because of the pandemic, you have to stop, and specifically the banks were going to be unable, as in not allowed to, buy back their stocks. They weren't allowed to buy back their stocks. They weren't allowed to pay out dividends or put any kind of distributions out there. And so because of that, when the entire market recovered, the economy, not the economy, but the market started recovering, the bank stocks have not been able to do the same thing. Of course, we can see some of the headlines. The Fed was cracking down on big banks to guard against risk to the financial system. That's why they said they didn't want them to do that. We can see here that they canceled the buybacks. Right here, you can see that headline. And you can see that during that time, the markets plunged. The black is the bank stocks, the red is the S&P 500. And you can see that both of them plunged simultaneously at the March 2020 when the pandemic broke out. But the S&P 500 rebounded really quick, Obviously, you can see this line right here. They're over their previous high, but the bank stocks have not recovered because of that. Because, as we saw the case, what drives the price of the stock? It's the stock buybacks, and they haven't been allowed to do that until now. The small change. So now we've just seen that the Fed is going to start easing that. They're going to allow these banks to start doing the buybacks in Q1 of 21. So of course we're in the first quarter right now, just ending the first quarter, and we've already started to see that. We've already started to see some of these stocks pumping and starting to close the gap. So it says the Fed allows the banks to resume, and we've already seen some of the prices drop as high as 5%. Now, a couple of things that we want to notice about this is that we can see that Wall Street was set for an $11 billion program to buy back their stocks on the Fed. And it said, again, right, the first quarter of next year, which is right now, we're in that first quarter. What's interesting is on that news, so in the market, we have the saying that says, buy the rumor, sell the news, right? So as soon as the rumor started coming out, as soon as the news started coming out, people started buying. We already saw the bank stocks jumping up 5%, 3, 4, 5%. And they plan to resume buybacks next quarter, which is, of course, this quarter. And they also intend to resume purchases next year. And since that news has come out, we've seen a much different story. Remember, up till here, you can see that bank stocks were lagging the S&P 500. And now look how much ground they've started to make up just based off of that news. But it gets even bigger because now, as of just a few days ago, they have removed the restrictions, and now we are back to a wide open market. As a matter of fact, on March 25th, the announcement came out that the banks are able to fully resume their buyback program and start issuing their dividends. It's going to be starting June 21st, but again, as you can see from that chart that I just showed you, the market starts trying to front run that news, buy the rumor, sell the news, so to speak. And so they've eased their restrictions on the payouts, and we're going to start to see a massive shift there. But now that I've set the stage for this, the question is, what does all this mean and what happens next? So we can see how this little shift back in 1990, over 30 years ago, had this drastic effect on how the markets work today. It's evident how you can see how bank stocks haven't been able to recover because they haven't been able to buy back their own shares and do distributions. But now, as of just a few days ago, that has been removed and it is game on. Now, what is going on with that? Well, here comes the pump. Let's talk about that for a second. So bank balances have been absolutely ballooning because they've been making an enormous amount of money from the Fed, from the reserves, playing these spreads, but they haven't been able to buy back any of their shares. They haven't been able to distribute any of those. So the bank balances have been ballooning. And now, of course, as we just talked about, the Fed's released the pandemic exemption. Now, you might have heard the last couple of days you've been paying attention about the SLRs. Those are the supplementary leverage ratio. So that's the ratio of leverage that the banks have to have, or I should say the amount of reserves they have to have for the loans that they make. They were talking about that. And of course, who gives the banks their reserves? Of course, it's the Fed. The Fed creates more reserves. So this is all coming together in this plan. We can see here that the bank's assets have ballooned during the pandemic, as I said, and that's because they haven't been able to do that. And what's important here is we can see, per the Fed, we can see that the temporary change to its SLR, supplementary leverage ratio, has expired as scheduled on March 31st. And so what this means is that now the banks are able to, they've had this amount of profit, their balances have swelled, now they can start to distribute that back out. At the same time, the Fed has created this SLR that's expiring, and I believe it's just a way for the Fed to start pumping out more liquidity in the banks. Now that the banks are gonna have to get rid of some of that cash, or I should say able to get rid of some of that cash off their balance sheets, they're gonna be lacking the SLRs. The ratios need to be maintained, which is an excuse for the Fed to, of course, pump them more money, as if the Fed needed any more excuse. It's almost like they're finding any excuse they can to do this, similar to how they use the CPI, the Consumer Price Index, to try to show that there's no inflation. So again, they can continue to pump out more money. So as I've been saying, I believe this year we're going to see more money printed than we could ever imagine. I wouldn't be surprised to see it past $10 trillion by the end of 2021. And this is just one more excuse to do that. Now, of course, what do we do about that? I've always said that as the Fed continues to pump out fake, fiat, counterfeit money, It's going to push people to buy real, hard, tangible things, scarce assets, beachfront property, productive real estate property, gold, Bitcoin, things like that. Things that are scarce, things that can hold their value. You do not want to be stuck holding this fake fiat counterfeit money as they continue to print trillions of dollars. That's what I got. Let me know what you think in the comments down below. Did I get this right? Did I get it wrong? Leave me a question. As a matter of fact, I'm grabbing the best questions and I'm answering them on my new channel, the Market Disruptors channel. If I pick your question to be answered on the video, I'm going to send you $25 in Bitcoin just for posting the question. You can find the link to the new channel in the description of this video. So write a question, I'm going to grab it, answer it over there, go watch the videos over there. If I answer your question, I'm going to send you 25 bucks in free Bitcoin. That's what I got for you today. As always, give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down. Either way, I want to hear from you, so leave me a comment, let me know. And that's it. To your success. I'm out.